Well, shares of Synopsys are higher after the company reported record full-year revenue of a little more than $7 billion US, with fourth quarter sales of more than $2 billion, which exceeded estimates. The company saw more earnings, helped in part by its acquisition of Ansys, an engineering simulation software company, which contributed nearly $700 million in the quarter. Joining us now to unpack the results is Andrew DeGasperi, the research analyst at BNP Paribas. Andrew, thank you very much for joining us today.
Thanks for having me, Roger.
What's there to like about the numbers that we're seeing from Synopsys?
Well, I think particularly the initial guide for fiscal 26 was a lot better than feared. This was the first time they were reporting an annual guide that included the full outlook for Ansys, which they expect to be low double digits. We have some concerns about that outlook, given after having a conversation with management. A lot of it is based on historical precedent and some assumptions being built in. But that said, I think the market saw that as a decent number to anchor their consensus numbers to.
Now, what are some of your concerns? What are you worried about?
Well, for one thing, Synopsys is undergoing a restructuring right now. I think you're going to see some changes across the entire organization. Also, we should note that they had a change in the chief revenue officer at the company. Typically, this brings some changes in the executive team at the mid-level. And we also note that, first of all, a lot of these large type of deals tend to be very difficult and not painless initially. So in the near term, we have some concerns that maybe the growth that they're giving out for the year might not be actually what the end result is.
And what are some of the headwinds are you worried about that they might see with that?
Well, for one thing, I think the broader organization of Ansys is not overlap exactly with EDA. I think only a minority of that business is consistent with what Synopsys does. So you have a lot of people that don't necessarily sell to those same customers. They also sell different products. So you tend to have what I call a difference in culture between the two. The other is that I would highlight that with Intel in particular as well, there's some changes going on at that company, and this was a major customer of Synopsys. And we foresee some potential changes in the mix shift of software licenses, particularly relative to its other competitors.
Is it difficult to try and merge when the companies are somewhat different, or bring them together, bring corporate culture together?
Absolutely, and particularly the larger the acquisition, the more difficult it is. I mean, in software, we can basically count on one hand how many large acquisitions have been made that have been ultimately painless. And what I mean by painless is that strategically maybe they make sense in the long run, and they actually did grow the acquirer company's top line and bottom line. But in the near term, you tend to have a lot of integration issues, whether those are technology related, whether those are sales motion related. And that is something that is hard to predict. So we're just, again, our underperform rating is based on some of those integration pains that are potentially likely to emerge, as well as some of the issues at Intel, which again are outside of the company's control. But given they were a predominantly large Synopsys customer, it's something that we see some headwinds in, particularly in 2026.
Yeah, I believe you're the only analyst with the underperforming 425 for the stock.
That is right. We see we're a relative underperform rating. Again, we don't see significant downside risk beyond what the market does. But what I would highlight is that it tends to I think most investors tend to look at Cadence and Synopsys and the valuation gap between them as how you should look at both companies. We have overthink that those are very different companies from one another. There is a reason why there is a gap in the multiple, and each company should be judged by their own merits. In terms of why we prefer Cadence, I think there's a story that has less noise. Even though they are similar, they have a much different exposure to the business. And I would also highlight the IP exposure of Cadence is much lower to Synopsys, and that is something that Synopsys has been guiding lower in terms of their expectations for the year.
And now we had reports of NVIDIA took a $2 billion stake. What kind of a factor do you see that being?
Well, I think that, first of all, I think that $2 billion stake is a huge, favorable, I would say, news headline for the industry as a whole, because it does indicate that NVIDIA sees a broadening of demand of the tools that Synopsys and its competitors offer outside of the traditional chip companies, for example, automotive, aerospace and defense, and manufacturing. And so those engineering workflows are primed to be disrupted by EDA, and in partnership with NVIDIA, we're likely to see an acceleration of the product development, joint product development between both companies. In other words, seeing software tools developed by Synopsys, powered by GPUs that NVIDIA is going to co-produce with them.
And I just want to ask, I just saw this today, if this is a factor at all. A law firm is launching a class action lawsuit against Synopsys, saying the company made false and misleading statements to the market. Have you seen that? I just saw a couple of stories on the wire today about that. Is that a factor at all?
No, I think that typically happens when you see the stock drop a significant amount, which had happened in September when they first guided IP revenue lower, and also the impact on from China. Recall that back in the summer, the U.S. government essentially instituted an EDA export ban into China, and that had impacted a lot of the revenues for the EDA providers. I will say that typically we do see class action lawsuits emerge from a significant downside move in the shares. So it's not a factor behind my rating. I would say it is just par for the course. We tend to see that in software when that happens.
Okay. Andrew, thank you very much for joining us today. Andrew DeGasperi is a research analyst at BNP Paribas.